Konnichiwa, Japan. It's a great honor to be doing this video recording. I wish times would be better that we could have done it live, but I hope to see you all in December, where we may go ahead with our outrageous prediction. But let's get to the today's topic, which is the market over the next 3 months, the next 3 years, and the next 30 years. A bit ambitious, but I'll try to take you through some of the major components. As many of you can see, this is a schematic slide that shows a supply chain in the workings. What we need to understand right now is that the concept of recession, based on what most economists use, which is a aggregate demand analysis, is wrong. The reason it's wrong is that it's really the elasticity or the lack of ability of the supply chain to grow, which is behind not only inflation, but also the consequences of inflation, which is higher interest rates. Maybe the best way to explain this is that during the pandemic, the aggregate demand that was transferred from governments to the private sector was the biggest ever in history. In other words, it's enabled the private sector, the SMEs and the corporates to have a very good starting position to deal with what is not a recession, but a significantly slowing of the global economy. So in other words, what we're dealing with is rather a situation where the excess demand that was driven by this handout of capital and money from governments, plus the green transformation that puts a very big tax on commodities, plus the whole idea about that monetary stimulus needs to be coming through low interest rate. That has all changed, ladies and gentlemen. It is important to understand that what is going on is that the excess demand is slowing, but excess demand is still higher than the supply that the economy can deliver. The way we like to say that in Saxo Bank Group is to say that the private market, the private sector, is way too small for the aspiration of the politician to do economic stimulus through monetary policy, fiscal, and green transformation. So in other words, the real economy is way too small to the overall size of what the public sector is trying to deliver. And within that, we see that the tangible asset, the asset that sits in the real economy, is now rising in value, while the more digital into the future earnings is being discounted negatively. But maybe being a European bank, we should start on the situation in Europe. So unlike what a lot of you seems to be thinking, Europe is not about to switch off all its lights and closing down. We have very high energy prices in Europe, but what is going on is a slightly different story than the one that you see portrayed in the newspapers. This slide shows you two things. On the bottom part, it shows you the actual price of the Dutch national gas contract and how it trades. We all know that natural gas, not only in the Netherlands and Europe, but also in Japan, is very high. But the important part is the top part of this slide. The top part of the slide shows a red line, which is the price of oil per barrel, $93 in this case. And on the other black line, you see a number that says 458. That is the natural gas equivalent price if this was priced similar to oil. In other words, you can see the ratio between 458 to 93 means that the price of natural gas right now is 5 times more expensive than oil. The reason for this is that in Europe, at least, we price all of the electricity generation on the marginal price of gas. The situation is, in reality, however, that on average, less than 25% of the energy input into creating electricity is natural gas. So in other words, right now, Europe is penalizing itself by paying for the price equivalent of $458 a barrel when they can, and in reality is already importing more oil and more coal to burn. So the real cost of energy generation is significantly smaller. We expect that is one of the reasons why that the EU governments are meeting to de-link this very wrong mathematical equation, which has been used to actually price electricity in Europe. It doesn't mean, however, that there isn't an energy crisis in Europe. There is such a crisis, and a lot of households across Europe is being penalized by very high incoming prices. The response, as always in Europe, is that the governments right now is putting in price caps, trying to control the price of energy, and they're creating massive amount of subsidies, not dissimilar to what you see in terms of petrol prices in Japan and in other places. This week, the new Prime Minister Truss in the UK introduced a maximum price of energy per household of £2,500. Right now, the price for some household is running at £7,000 and £10,000 a year. This means that the government in the UK will need to create a lot of money to subsidize this economy. So maybe the first sort of conclusion we do on the energy crisis in Europe is that European growth will be improving simply because the amount of money that again gets transferred from the government into the fiscal pockets to support energy and food prices for the European citizens means there is a transfer of wealth coming to the private sector again. This ultimately means that this concept that Europe is about to close down and switch off the light is not going to happen. The slowdown in the economic growth in Europe will be coming, but it will be significantly smaller than the consensus is agreeing on right now. So the first conclusion here, yes, there is a slowdown. Yes, there is an energy crisis, but two things is happening. One is that the EU as a whole will decouple the marginal cost of electricity to a lower price. And two, there will be a fiscal expansion in Europe that will support growth over the medium term. If we then look at the recent developments in Europe, there's been some concerning news. This slide is from a recent weekend's press, and it shows you, among other things, that the Swedish government has set up a $23 billion emergency backstop for its own utilities. Said differently, basically the companies that produce electricity had a margin call from the markets that meant that they were short of capital, and if the government didn't step in, they would cease operation and go bankrupt. Instead, as is always the case, not only in Europe, but also in Japan and the US, when infrastructure is at risk, the government steps up. The same weekend, Germany announced that they had $65 billion package to curb the soaring energy cost. I think this is a clear indication of the conclusion I drew you to before, that Europe is fiscally expanding, and this is a trend we will see in Asia, we'll see it in Japan as we come into the winter, that the governments simply need to take responsibility for not sourcing energy correctly and not making sure that the price mechanism work. So expect fiscal expansion globally, and expect that fiscal expansion globally in 23 to mean that there will be a pickup of overall GDP, but also because we are not dealing with the energy crisis by subsidizing the demand, we are actually making sure that energy prices and hence inflation stays high for longer. If we then move into sort of one of the reasons why that we have a supply side crisis, this is probably the most potent, the most important slide you're going to see for your investment horizon over the next 10 years. It's very simple, yet very telling. What this slide shows you is that in 1975, the intangibles, the IPs, the digital economy was 17% of the overall economy in valuation. Fast forward to 2020, the digital economy, the financialization of the economy means that 90% of all assets sits in non-tangible assets. Two conclusions from this. One is that the digital economy cannot get bigger relatively to the overall size when it's already at 90%. But more important, and with direct consequences for you as an investor, it is pretty clear that if you have too little supply going into an economy due to underinvestment, regulation, and green transformation, what needs to happen is that we have to rewind. We have to move back to a year like 95, where the intangible was 68% and the real economy was 32%. In other words, what will happen with the economies over the next 10 years is that your government will build out the infrastructure, will need to commit to more basic research, will need to go to the road which is called productivity instead of just almost blindly issuing debt. This may be the biggest news that's happened in my over 30 years of doing these analysis, because what is going on right now is that the market is being told by the lack of resources that in order to move forward, in order to get to a better place in terms of lower inflation and higher growth, we need to focus on productivity. All surveys, all analysis shows that in order to move to this higher productivity level, you as an individual, you as a company need to invest in productivity. Investing in productivity actually means that basic research and education is the two single most important sources. So an economy that constantly talk about digitization, actually what's going to make a difference is people. People who lives in the real world, not people that live in the metaverse. Metaverse may be very nice to do for 1 hour a day, but the problems we have in the world is in the real world. We need people who can do energy better, can do pollution better, water better, school system better, and certainly to a large extent in Asia also do governments better. So in my opinion, what we stand in front of and the conclusion we need to take is that this supply chain issues that we've seen in Europe and globally is really going to be the platform from which we move to an agenda of increased productivity, increased investment into infrastructure, and through that we get to a better place. If you were a little bit facetious, you could say that this is actually the best thing that ever happened, and inflation was the only instrument by which we could go from an economy which was entirely built on issuing more debt at low rates and maintaining very low inflation to an economy where we actually allocate capital to the most productive means and the most productive output that we can find. The reason this will happen is not because it would be nice. It's not because I say it. It's simply because society as a whole cannot survive if we don't move to a higher level of increasing the size of the real economy versus the digital economy. This does not mean, however, that we are going to say that the technology doesn't work. I have seen here in Japan, and I have been privy to a few conversations with government officials that shows me that over the next 2 to 3 years, a country like Japan is going to move to a similar development that we have in Europe, where digital government personal ID is the main take. A situation where we improve the flow of funds, the flow of information between government agencies, tax authorities, and companies. In the process, this is going to release very positive potential tailwind. To make this more practical, what I'm really saying is that the tangible side of the economy will grow and offer you as an investor the best return. Maybe the best thing I can do to prove that is to look at the year-to-date performance of all the baskets that we use in Saxo Bank to monitor the development between not only sectors, but also companies that runs the economy. As you can see from this slide on the left-hand side, if you look at the YTD, which stands for year-to-date, you will see that commodities is up 17% for the year. Defense stocks is up 7%. Renewable energy is up 1.5%. And then the rest of the sector is down for the year. The companies doing worse is the segment of cryptocurrencies, e-commerce, bubble stocks, payments, next generation, medicine, and semiconductors. The exact same names that over the last 10 years was the best performers. So not only in principle and in theory have I tried to show you that if you invest in real people, in real investment, in real productivity, in education, and overall making sure that you live a productive life, you will make your life better, but you will also actually make money. We expect this trend to continue, and we actually expect that the fiscal expansion that I talked about earlier will then translate into a huge amount of government effort to digitize what is not being digitized, but more importantly, make sure that you have a strategy on energy, a strategy on school, a strategy on basic research, and a strategy on how we make sure that society going forward reduces some of the inequality and the big gaps that we have in social standards. Again, I have done this for a very long time, but I will say this is the single most important moment in my trading career. And as the lack of hair will tell you, I've been around so long that I was trading live when the Berlin Wall fell in 98, or in 89. I was there in 98 when Russia went bankrupt. I was there basically for every single crisis that you ever seen. This is not a crisis. This is a moment where we wake up. This is a moment where a lot of economies, including Japan, are being forced to react. They will react to a more productive state simply because they have to, not because they want to, not because it's politically opportune, but simply because the real economy in size needs to grow relatively to the intangibles. For too long, we were sort of trying to tell ourselves that we could all be rentiers, we could invest capital without doing anything and then reap a return for ourselves. Not in the future. In the future, fortunately, the people who would do well, the companies that would do well, will be part of the solution, not part of the problem. I will end with additional comments on China and then on dollar yen. So similar to what I indicated before, many people I talk to say that China is about to close down. China's property sector is a big issue. There is a lot of bad debt in the economy. And overall, China doesn't have the ability to, one more time, to re-engineer a growth path. Of course, I have no predictive power, but certainly knowing China as we do in Saxo, we are pretty certain that China will be back. What we think is happening right now is that China is already on the move to have an improvement in growth. At the far top side of this slide, and maybe I can use the cursor to show you here, we have the credit impulse. Basically, the credit impulse measures all the credit initiatives you have in China, and the credit impulse itself is leading the economy by 9 months. So in other words, the credit impulse starts to turn around approximately 9 months before the economy turns. You will see here that the Chinese credit impulse actually in 22 has been improving quite dramatically, meaning whatever growth level you have in China today will be higher in 9 months from now. Whether that starting point is 2% growth or 1% growth, it's for you to determine. But economic activity will be higher 9 months from now. We also need to acknowledge that in October, the National Congress will meet in China, meaning that the political quiet period disappeared and the next 5 years of policies needs to be instituted in China. This road will be paved with investment, again, similar to the rest of the world, with green transformation, building out strategic resourcing, and making sure China lives up to its own circular economy basic, which is to rely less on foreign products and more on domestically and Asian produced goods. In other words, we again do not buy the concept that China is falling off a cliff. Rather, we think there is, in terms of price and levels, a good opportunity to see China actually positively surprise on GDP growth, this contribution to growth to the world, to the commodity space, because China remains the biggest buyer of commodities, but overall, I think also even in the stock market, because it has become extremely depressed. As I am in China, I need to address the issue of dollar yen, of course. I think every single person I met, including my waiter at the bar last night, wants to know what I think about dollar yen. First, I'll say you probably know more than me, but let me outline what I have observed and what I think is going on right now. The tripart of the government, Ministry of Finance, and Bank of Japan is making noises that they think the devaluation of the yen has gone too far. This is the classic sort of central bank early warning signal. You increase the rhetoric, you're trying to talk to the market, you're trying to take the market to make sense. The problem is the market often want to test how good a parent you are by being a little bit more unruly. But as this happens, we are also in a situation where the situation globally is that Japan has $3.3 trillion worth of overseas assets. So if you want to understand where dollar yen goes, you really want to understand what the overseas holdings that Japan holds will do. Will they be repatriated because there's a crisis in global equity markets? Then dollar yen goes down. If the Ministry of Finance issues a decree that the pension system, the insurance companies and the banks needs to reduce its overall foreign exposure, that could also help to create a top in dollar yen. Most importantly, I think what is really going to transpire is that over the next 3 months, the US Central Bank, the Federal Reserve, will move to a position where they are the most hawkish there will be in this cycle. Some of you will have noticed that the Jackson Hole speech was short in minutes, but very clear on message. They said, listen, you doubt that we will deliver on a very hawkish mandate to fight inflation. Let me tell you, we are delivering this inflation fight. This means that we have to expect that US interest rate will go up at least to where the market foresees it in terms of forecasting, but probably a little bit higher too. I see this moving the 10-year US Treasury yield from a level of 330 basis points as I speak today towards the upper limit being 4%. But as we get very close to 4%, we are probably also reaching a level at which US can no longer afford that interest rate continues to rise. If 4% is the ceiling, then the dollar needs to weaken. And this is where the cycle is being closed, because if you combine the overseas holding, the potential for Ministry of Finance to issue a decree on repatriating capital or a sell-off in the global market, and the fact that we are probably in a window of highest, biggest hawkishness we will see over the next 3 months, sometimes in January and February, all of a sudden we'll have a pause, a break from higher interest rate, and that immediately would impact the relationship to dollar yen. So in other words, I think in a baseball analogy, in dollar yen, we may not be in the 9th inning, we are definitely in the 7th, and some of us may think we are even in the 8th. But for now, the dollar remains strong because this hawkish window, which I think will have high volatility, negative equity returns, is in place. We need to allow a little bit of time to run to test the mandate of the Federal Reserve, which is now entirely built on a concept of delivering enough interest rate hikes to dampen inflation. So in other words, ladies and gentlemen, we stand in front of the 3 most volatile months of the year. Liquidity dries out as we come into December. But what is happening under the micro level here on the energy sector, in the commodity part, is that we are moving to a better place. As they say in the futures market, if you want lower prices, you need higher prices. Higher prices are coming, but higher prices is good because it redistributes the way we allocate capital. It focuses the mind of not only government, but also business owners and not least households. So if you want to benefit from this, in my opinion, and again, I am no sage, I have no predictability, I am definitely with my team overweight the sectors in terms of equity, which are commodities, energy, defense, cybersecurity, and a little bit of renewable energy. Whether you want to do that or not, of course, it's entirely up to you. This is not advisory. It's only an educational podcast that we're doing. But to close out, I want to wish you a very safe travel throughout the next quarter. I hope to see you all live in December. And I wish that all of you have the softest of landing from a global economic environment, which is going to test us. But remain absolutely sure that I believe in you. I know you believe in yourself, and we can deal with this. So let me end as I've ended every single speech in the last 25 years. I am the most optimistic I've ever been in my 30 years of doing this job for one reason only. It cannot get worse, ladies and gentlemen. Let's work on that basis, and I wish you good luck and safe travels. Thank you very much.